This is Daybreak Asia. We're counting down to Asia's major market opens. And of course, we are watching at the start of a very, very busy week for Asian central banks as well as earnings. We are expecting holds across the board when it comes to these central banks, including the likes of New Zealand holding their meetings this week. We're also getting RBA minutes as well as a Fed meeting minutes from their recent gatherings as well. Also a big week when it comes to earnings. Some of the Chinese EV names will be in focus given the heavy discounting, given the geopolitical tensions and the overcapacity claims that are at play there. And of course, semiconductors will be front and center as we get those NVIDIA numbers. Let's get you to Avril Hong, who's in Singapore for the market opens. Avril.
Yeah, on those NVIDIA earnings, it's interesting how we're seeing in the options pricing, it seems to suggest that investors not willing to pay that premium in order to participate in the rally of the marquee stock, so to speak. And we're seeing potentially that will be a driver this week. But on the stock markets, it's a bit of a mixed bag. We did get a bit of a tailwind from last week after US stocks eked out those fresh records towards the end of the week, but also that added lift coming through from Chinese authorities as they mull those proposed plans for property to put a floor under that sector. And indeed, as we hear about how the PBOC is going to come through with funding for bank loans for state-owned companies that have been tasked with buying up these unsold homes of distressed developers, that is something else that we're watching in the Asia Pacific as well. So for now, we're seeing not that much moves on Japanese equities in South Korea, a bit of a climb, dollar yen moving towards that 1.556 level. Of course, something that we've been watching the later parts of last week was that unwinding of those Fed rate cut expectations. Let's flip the board and take a look at what we're seeing in Australia today, because we did see the ASX 200, of course, ending the week with declines, a bit of a recovery, and the Aussie also has been in focus. Remember that jobless surge, that data out of Australia prompting RBA rate cut bets. We'll be keeping a close eye on those minutes later in the week. Tomorrow, that is. We're seeing the treasuries in the US climbing. Brent, of course, is also in focus after those fresh attacks over the weekend, putting the geopolitical risks out of Ukraine and the Middle East in focus again. We saw weekly gains. It's sitting just below the $84 a barrel handle now. Heidi.
Let's bring our next guest who expects the market turbulence that we've seen to eventually moderate. Let's bring in Yuting Shao, who's the macro strategist at State Street Global Markets. Yuting, great to have you with us. And I guess that's an interesting view because there's still quite a great deal of uncertainty in terms of how the inflation picture plays out from here and how central banks react to that. There's certainly no consensus at this point in terms of when, and if the likes of the Fed will actually start to cut.
Right, definitely. So, given recent events, there's definitely relatively higher turbulence compared to what we've seen in the past few months. But right now, what we have is it's more of a, to your point, directionless a little bit, given that investors are pretty much now hugging neutral when it comes to both the flows and holding preferences they have. But I guess the sort of the anchor of the market comes down to the Fed and a lot of the rates repressing that we've seen. And right now, we do see a little bit of cool off when it comes to U.S. data and a little bit of better hope of the Fed can actually enter into the cutting phase later part of the year. So that definitely helped in terms of anchoring market confidence a little bit. But also on top of that, we also had over the past week more positive news out of China as well. So all these factors come to help anchor the preferences for risky assets. So even though we have turbulence that are relatively higher in recent weeks, we do expect those to moderate a little bit from here on out.
When you cast your eye across Asia, where do you see some of the opportunities at the moment? Is it time for sort of another leg up when it comes to Japan? Are you seeing more opportunities in adjacent South Korea, for example, given the return of foreign inflows to that market?
We're actually a little bit more sort of conservative when it comes to North Asia space. We think, Korea, even though it does have the tech export benefit for the overall economy, there is still sort of a little bit concerned surrounding the overall China story, and investors can use Korea more as a risk proxy for its overall risk sentiment towards North Asia. So where we like a little bit more is actually on the South Asia side. We do still like India, given its relatively more stable growth outlook. So that's where we stand in terms of the overall Asia space.
What do you like in India? Because valuations are not cheap at the moment.
Right. Valuation is not cheap at all, but it's not as extreme as some of the other markets that we've seen. And also, to my point, in terms of the overall growth outlook, it's still quite stable. It is still a relatively domestic-driven economy, but also in terms of geopolitics, even though we still have the ongoing election that's currently happening. Looking forward, we still expect more sort of market-friendly reforms and policies out of this current ongoing election. So that definitely helps in terms of the overall investor preferences towards the whole India space.
What about China? We've had sort of more incremental measures from policymakers to support the property market. Do they convince you that makes, a pretty cheap entry point back into Chinese risk assets?
Right. So in terms of the overall China space, what we think is that what authorities have done, especially coming out of the Friday announcements, is definitely a right move in the right direction. But I think a lot of the uncertainty still surrounds that in terms of the funding gap, in terms of how effective those policies are, especially towards the lower tier cities where you have a bigger sort of disconnect when it comes to the structural imbalance of supply and demand. And ultimately, what it matters is how consumers or home buyers perceive those measures and whether that changed their purchase preferences. So we're still a little bit conservative. We think it's definitely the right move. But I think, more can be expected and more support is likely to be needed to have more of a turnaround when it comes to sentiment toward China.
Yiting, how much volatility are you expecting when it comes to geopolitics? Obviously, the Middle East remains a source of tension, but we're also heading pretty quickly into the November elections. We've already seen tariffs being utilised really by both sides.
Right. So the Middle East geopolitical situation is definitely ongoing. We do see commodity prices moderating a little bit in recent weeks, but of course, as long as there's this ongoing uncertainties in Ukraine or surrounding the Gaza Strip, there is definitely elevated risk that things could deteriorate. But when it comes to U.S.-China relations, heading into a November election, as we approach that, of course, to your point, geopolitical risk is likely to stay elevated. But I think for the Chinese side, there is certain understanding when it comes to a lot of these measures or rhetorics heading into an election is in a way unavoidable. So, on the flip side, we do have a lot more higher level communications and meetings that we've seen in the past few months, definitely a lot more compared to the past few years. So what that helps is definitely sort of putting guardrails or putting a floor on the relationship. So there is definitely challenges going forward heading into a November election, and there's definitely a lot of uncertainty surrounding that. But I think both sides, at least at the moment, doesn't want to make things too much worse from where we were from a few years ago. So that's pretty much where we are at the moment.
Yiting Zhao, who's a macro strategist at State Street Global Markets, are with us. More to come here on Daybreak Asia. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Season is here.
This is a get out the popcorn moment.
And across the board, just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey, folks, we've got Microsoft.
Apple earnings crossing the wire. Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
A lot still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment? I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
Rescue teams in Iran are searching for President Ebrahim Raisi after the helicopter he was travelling in crashed. State media say dense fog in the region is making conditions extremely difficult. More, let's bring in Bloomberg's Michael Heath. So what do we know so far? We know the foreign minister was also on that same helicopter.
Yeah, Heidi, and there were also some regional officials with them. It was a party of 3 helicopters, and initially they said that the president's helicopter had had a hard landing. Now it looks like it might be a bit more serious, that it potentially was a crash. I mean, this is a mountainous region, as the pictures we have are showing. It's dense fog. There's actually a Turkish drone that's looking for that's trying to help in the search efforts, and it's actually broadcasting, or it's purportedly broadcasting on Twitter, and it just shows how dense the cloud is. That it's very, very difficult to see anything down there. So it's going to take some time for rescuers to get into the site. So that's all we've sort of got at this stage. I mean, he was returning from the neighbouring state of Azerbaijan. They'd opened the president of Azerbaijan and the president of Iran had opened a dam on the border, and then he was flying back from that when this accident reportedly occurred.
So this is a man who we've heard from the Supreme Leader, and this is a man who is widely seen as his successor.
Yeah, and this is I think probably the most important political issue, because at the end of the day, the Supreme Leader, the Ayatollah, he runs Iran. He's the decisive voice when it comes to politics, etc. But Raisi was said to be groomed to take over the role. The Supreme Leader is 85 years old. Raisi's in his early 60s, so it was sort of a natural next step. Now, if the worst has happened and he's died in this crash or something like that, it potentially throws succession plans into doubt. But it's still at this stage, you know, we're kind of speculating because we really don't know what the situation is on the ground there. But yes, he's certainly seen as the Supreme Leader's man, and he's been very tough. He's got a history of a hardline approach. When 2 years ago, when there was the protests in Iran, when a girl was died in custody after being arrested by the morality police, there was quite a severe crackdown there, and historically he's been involved in quite a few crackdowns as well. So yes, he's a definite hardliner there.
And Iran's opponents, as well as partners, would be watching this very closely, particularly when it comes to Israel.
Definitely. I mean, President Biden, the White House has said he's been briefed on it. Israel obviously would also be looking at it. I mean, it comes at such a serious time in the region, given that Iran just undertook its first barrage against Israel as well, even though most of those rockets were shot down. We have the Gaza war that's still unfolding, and we have Netanyahu as well, who's having some problems in his own war cabinet. So what it sort of shows is, when you brush aside the war, we sort of understand that even politically, wars aside, politically the Middle East is a very unstable place.
Unstable seems to be a fair characterisation of what we're seeing with Netanyahu's war cabinet, right? There's been sort of, threats and lots of dramatic positions being taken, but is his is his own role in jeopardy?
My understanding is no, and that's sort of what our reporting is showing as well, is that Benny Gantz, the opposition leader, I mean, Israel has its normal cabinet, but also has a war cabinet that's prosecuting the campaign against Hamas, and that involves Netanyahu, the defence minister, and then Benny Gantz, who's from the opposition. And Israel traditionally does this when it goes to war. It is the opposition and the government unite. And that has worked. That worked very, very well initially, that triumvirate, but it's been breaking down from all sides. They've been saying that in recent weeks. People are barely speaking to each other. Gallant, the defence minister, came out last week with demands that Netanyahu actually come up with a plan for Gaza after the war. And now you've had Gantz. He's basically given Netanyahu an ultimatum of several things he needs to see, or plans for which he needs to see in the next couple of weeks, or he'll withdraw. Now, that wouldn't be great for Israel, but Netanyahu holds a majority in the Knesset, and they've just sort of started their summer period of parliament, but basically after about July, if his government lasts until then, it's unlikely that any elections would happen until next year.
Bloomberg's Michael Heath there with the latest across that region. And you can, of course, get the latest on what's happening in the Middle East and the other stories you need to know in this morning's edition of Daybreak. Terminal subscribers can find that at Daybreak. It's also available on the mobile in the Bloomberg Anywhere app. It's a big moment for global politics, certainly. Lai Ching-te is set to be sworn in as Taiwan's next president in a few hours' time. His inauguration address will be closely watched for signs of how he plans to navigate the island's complex relationship with the US and China. Our Chief North Asia correspondent Stephen Engel is in Taipei and joins us now. And of course, the key focus is how he addresses the one China issue. We've not heard a great deal so far.
Yeah, that's right. I mean, he will be sworn in within the next hour. At 9 o'clock, the inauguration ceremonies are going to begin outside the presidential office, or it's actually the swearing in will happen inside. He and his vice president candidate, shall be Kim, of course, more recently the Taiwan's representative in Washington, D.C., so she comes with a lot of foreign experience and credentials. So it will be a continuity candidacy and presidency with Lai Ching-te taking over from Tsai Ing-wen, whom he was her vice president. And again, he won the election, but it was a three-horse race that kind of divided up by three ways. And he did not win a very strong mandate at all. He got 40% of the vote. The KMT of the candidate Hou Yu-ih got 33.5%. Then there was the wildcard candidate Ke Wen-je of the upstart TPP that won 26.5%. But more interestingly, and maybe more importantly, in the early days of this administration will be the divide in the legislative yuan, where the KMT, the opposition, took one more seat than the ruling DPP. So we'll talk about that in a little bit. The big issue, obviously, as you just alluded to, Heidi, is going to be the cross-strait relations. He's going to give a speech today that will likely talk about reaffirming the status quo in cross-strait relations with China at a time, obviously, that Beijing is watching this very closely. They have labeled Lai Ching-te a number of different things, including instigator of war, a dangerous separatist. So they'll be watching his tone and his word today. We've heard that he's likely to keep on about being, a continuity candidate, but bringing stability to policy here in Taiwan. And there will be a number of guests, but it's more like the who's who of world leaders, because, look, it's no doubt that the pool of diplomatic relations and those who recognize Taiwan as a sovereign state is dwindling. Actually, since 2016, Taiwan lost 5 different Latin American nations to Beijing, including Panama, Dominican Republic, El Salvador, Nicaragua, Honduras, and here in the Asia Pacific, most recently January, they lost Nauru. In 2019, they lost Solomon Islands. So that pool of diplomatic allies has shrunk quite a bit. So the list of dignitaries going to be here today includes the King of Eswatini, that's formerly Swaziland, the King Mswati, also the President of Paraguay, the Prime Minister of Belize, the President of the Pacific Island of Palau, the President of Marshall Islands, the Prime Minister of Tuvalu, and a few others, including representatives, an Archbishop from the Vatican, and a few U.S. guests, including the former Biden White House economic advisor Brian Deese, the the former Deputy Secretary of State under the George W. Bush administration, Richard Armitage, as well as the chair of the de facto embassy here, the American Institute of Taiwan, Laura Rosenberger. So again, it's not the who's who, it's the who's who is coming here again as Taiwan under DPP maintains a status quo relationship, at least that's what they're trying to maintain with Beijing, and not necessarily rattle the sabers, but again, they are not engaging necessarily because they have not really ascribed to the 1992 consensus, which essentially says we can agree that there is one China, but we can disagree on what the definition of what one China is. So it'll be a very interesting day for sure to see Lai Ching-te's tone in his inauguration, after his inauguration, in tone of his speech.
Our Chief North Asia correspondent Stephen Angle then will bring you, of course, that inauguration, Lai Ching-te's inauguration as Taiwan's 14th president. As it happens, we get more analysis too with our guests in Taipei at those times on your screens. Other stories that we are following today, another big political story that we're watching: China investigating its Minister for Agriculture and Rural Affairs for what it calls serious violations of the law. Tang Renjian is the latest high-level government official to be investigated for alleged wrongdoing. He was appointed Agriculture Minister in December 2020. President Xi Jinping has spearheaded a sweeping anti-corruption campaign since 2012, ensnaring dozens of Communist Party officials. Saudi Arabian state media says King Salman is suffering from a lung inflammation. The official Saudi press agency says the 88-year-old monarch will receive antibiotics at the palace in Jeddah after developing a high fever and joint pain. King Salman has led Saudi Arabia since 2015. The illness comes with his son, Crown Prince Mohammed bin Salman, expected to travel to Japan this week. More to come here on Daybreak Asia. This is Bloomberg.
Do you feel like this age of abundance over the last few years of just how much was being made?
For my personal taste, I am thrilled at what I get to find every night if I have time to look for something. So I personally don't think too much was made. I think the customer will tell us when there's too much made and they won't watch things. And I think part of the misalignment I talked about before is, imagine if things didn't get picked up or movies didn't get made that people didn't watch or go to see. That's how it used to be. The customer decided. I do think there's going to be less made in the middle price range. I think there's going to be more made in the higher price range, because when you get to global events like Barbie or Oppenheimer or Super Mario Brothers, it's worth the investment, and it's clear that the audience is there, and they just need to be given what they want. The middle, which ends up, quickly on one of the services in a way that we're watching movies that we don't know how they got made or when they got made and all of that. I think that will probably be curated better, and I hope there's more inexpensive things that give more people the chance to express themselves and have their work seen.
Take a look at how US Treasuries are trading at the moment. And of course, it was a big week when it comes to Fed expectations and a lot of pullback when it comes to these concerns that the easing will come sort of later rather than as early as markets had been building. We've seen Barclays ditching a call to short 10-year Treasuries, which has been one of the kind of recent developments that we've been following. Some of the biggest bond market bears on Wall Street are ditching that recommendation to bet against 10-year US Treasuries. They say that the shift in positioning is happening after after the recent rally is likely to curb any rise in yields. We've already seen this kind of bond rally built pretty quickly on inflation euphoria, but some of that, at least globally, for other government debt may actually face a bit more of a challenge. We have had global government debt seeing its best month of the year. Of course, the inflation print from the US showing a bit of an ebbing for the first time in 6 months, even if perhaps the details show that the sustained flight against inflation might be a little bit trickier for the Fed going forward. Bloomberg opinion columnist and Queen's College Cambridge President Mohamed El-Erian says the Fed's delay of rate cuts to temper inflation runs the risk of falling behind the curve. He says it's not the real economy, it is the real economy, I should say, not inflation, that will ultimately force the Fed to pivot.
I think the big issue right now is that we as a profession and we as a market are too influenced by what happened after the global financial crisis. We believe somehow still in the back of our mind that low interest rates, very low interest rates, are the norm, not the exception. We believe that inflation is not an issue. So look what has happened to the Fed. The Fed pivoted on the basis of data. It was the opposite of the pivot they did in December when they pivoted on basis. Now they have to do a U-turn. As they're doing the U-turn and say higher for longer, the market is going the other way. So you saw what happened to the 2-year, you saw what happened to the 10-year. And then there are two really problematic issues that we don't talk enough. How sensitive are the stubborn components of inflation to interest rates? They're not very sensitive. That's problem number one. Problem number two, what indications are we getting of the economy? It's slowly weakening. So it raises the issue that once again, the Fed is going to have to pivot, this time not on the basis of the inflation numbers, but on the basis of the real economy numbers. It will pivot yet again. And then there's the big issue that I know no one wants to discuss.
Go on.
And I insist, and I understand that fully, is the inflation target the right target? We all talk about wanting to go back to 2%. Every single quote you had this morning assumes that 2% is the right inflation target. 2% is totally arbitrary. But I understand why no one wants to talk about this. But we should all realize that if we are pursuing the wrong inflation target, the risk of a mistake, and that mistake would mean sacrificing growth unnecessarily, the risk of that mistake is high, especially when the low-income people are most at risk.
Bloomberg opinion columnist and Queen's College Cambridge President Mohamed El-Erian there. Take a look at how futures in Europe are opening up. We are seeing a pretty solid setup here in Asia for the start of the session over in Europe. And of course, we have had a little bit of that pullback expected potentially when it comes to certainly UK gilts and some of the European government bonds that we've seen rallying alongside treasuries. This is a picture when it comes to the potential recovery that we see in European stocks. Stocks 50 futures are much about 0.25%. Muted upside for German DAX futures there as well. We did have a lower finish for the European session on Friday. A little bit of a pullback in Wall Street, but still, of course, certain markets notching record highs there. The commentary from central bank officials, the Fed officials, sort of curbing some of that rate cut optimism there. But those muted losses looking like we'll be back to gains when it comes to the start of trading in Europe. Seen those rate-sensitive sectors, the likes of utilities and real estate in Europe coming under some pressure, but some outperformance, interestingly, when it comes to consumer as well as banks. We had Richemont, the luxury company, of course, jumping after some leadership changes there. The ECB executive board member, Isabel Schnabel, also warning that back-to-back rate cuts in June, July, that the caution is more likely to be needed. So a little bit of caution there returning to the European markets as well. More to come here on Daybreak Asia. This is Bloomberg. We are seeing early Asian markets trading broadly higher at the moment. Let's get some details now with Avril Hong in Singapore. Avril.
Yeah, Heidi, we're seeing that tailwind from how U.S. stocks eked out those fresh records last week coming through in the Asia-Pacific session. Of course, this is driven by the corporate earnings resilience. And the big one we're going to be watching out for this week is NVIDIA. Although something worth noting here is how in the options market, it seems to suggest that FOMO trade might be easing. Now, the other tailwind for Asia stocks has been, as of last week, the optimism surrounding authorities potentially doing wanting more for the real estate market. And indeed, that's what we got at the end of last week, with Chinese authorities scrapping the mortgage floor, lowering the down payment ratio for individual home buyers, and of course, the PBOC funding plan for bank loans that will go towards, these state-owned enterprises and how they're likely to kind of mop up the excess inventory and the unsold homes. So those are the drivers for the markets in the Asia-Pacific. And as you saw there was a lot of green on the screen. But something else that's worth noting as well is how we've seen, even amid the scrapping of the mortgage flow, the reality is it is already really, really low. That is what we're seeing on the ground, Heidi.
And, as you mentioned, Avril, part of the sort of enthusiasm, we're seeing more support measures out of Beijing. Is there some concern that these measures are a little bit too little too late?
I think there are some parts of the market that are also questioning not just whether these measures are coming in time, but also the size and how they will be implemented. If you think about how some estimates put the amount that will be needed in terms of vacant homes and to kind of clear up the excess inventory, it's talking about multiple trillions of yuan. But this facility that the PBOC is pushing through is only going to, I think, help with about 500 billion yuan. So there is a gap in that regard. And how will this all be implemented? That is another key concern. But in the meantime, we've really seen how stock market participants have been very exuberant, as you say, enthusiastic about these support measures of late. These trading volumes as of late last week really spiked, Heidi.
Let's bring in Hao Hong, who's a partner and chief economist at Grow Investment Group. Hao Hong, always great to chat with you. And, particularly at a time where there's increasing scrutiny after almost 3 years of this property sector downturn just dragging on. As Avril alluded to, the measures being proposed, the package that's been sort of discussed, would only address a mere fraction of the properties that are in question here. So does this make a meaningful difference to you in terms of boosting confidence?
Yeah, I think the package, the market was looking for a substantially larger package. If you want to clear out the excess inventory, which means that in a normal property cycle, it takes about 18 months, right, for one inventory cycle. So now the market has about 2 years, probably even more than that, of inventory outstanding in the market. So if you want to go from 25 months to 18 months, right? So you need probably about 7 to 8 trillion yuan worth of money. So I think with the special long-dated treasury bonds and also some of the recent stimulus measure, including the rediscount loan, I think it amounts to about less than 2 trillion yuan, right? So it's a far cry from 7 to 8 trillion yuan we're looking for. Yeah, so it's substantially less than what the market was looking for. But then at the same time, this rally when it started, since the bottom just before the Chinese New Year to today, it hasn't got that much to do with the property package, right? So the market was rallying before this announcement. So I would say that even though the package is smaller than expected, but if it doesn't work, then there will be more stimulus coming on our way.
So, yeah, it's interesting because our question of the day is, how far will Chinese equities be lifted by these property measures? You're saying, well, it's kind of an irrelevant question because this is not what the rally has been driven by so far. So if investors are sort of willing to announce ignore the kind of, death by a thousand cuts of what's happening with these beleaguered property markets, what are the actual property forces, the positive forces, I should say, that are driving, valuations and potentially a fundamental re-rating of Chinese stocks?
Yeah, well, I think everyone knows that the Chinese market is very cheap, right? So if you look at the recent numbers, right, it's not the property that is driving the economic recovery. It's really the manufacturing sector and the export sector that is driving it, right? So. And because of that, people were focusing on, Chinese over investment in some of the sectors, over capacities, et cetera, But it's really, this manufacturing sector, infrastructure spending, that is driving this recovery. But then at the same time, the consumer is still lagging, right? So even though, we're seeing encouraging consumption numbers, but the consumer is still the weaker part of the economy, right? So if you look at the stimulus package announced last Friday, so it's close to 2 trillion yuan worth of stimulus, and if you think of the property sector being part of the consumer sector, which is a very important part of Chinese consumption, right? So when the Chinese household buy a house, then they tend to buy all new furniture, another new car, etc., right? So it's a very important consumption driver. So if you think of the 2 trillion yuan worth of property stimulus as a consumption stimulus rather than a stimulus for the property sector, then it sort of makes sense, right? So on one hand, you have manufacturing that is, going all banana, and then at the same time, you're trying to divert some of your stimulus back to the consumer sector, trying to help the weaker part of the economy, and also to address some of the international concerns about overcapacity. And that way, you actually get a more balanced growth going forward, rather than you only having the manufacturing sector and the infrastructure sector that is driving it.
I always enjoy reading your market views and your notes because they're quite philosophical, right? You've talked a lot about the kind of dualism, which I guess you can extrapolate to talk about what's driving Chinese risk assets. Where do geopolitics fit into this? Because we've seen tariffs being manoeuvred by really both sides in terms of now kind of mainstream toolkit going into the election, right? Does that have an impact meaningfully on China?
I think right now, a lot of international attentions, being, focused on the Chinese overcapacity issue, right? Because if you look at the Chinese EV sector, right, in the past 2 years, China gone from a car importer into a sort of one of the biggest car exporter of the world, right? So it's cutting everybody else's lunch, right? So so unavoidably, you're getting, criticism from especially from Europe and also from the U.S. And therefore, you have all this tariff negotiation going on. Right? So inevitably, if China doesn't do anything, then, it will sort of induce even more criticism on how the Chinese government managing its economy. Right, so right now, we're trying to make a tentative step, to address this problem by stimulating the consumer sector and the property sector, while trying to rebalance the economy. So it's still early days, right? Because we all know that 2 trillion is far from being able to solve it. But then at the same time, you also have to address some of your trading partners' criticism about overcapacity. All right, so it's a balancing act right now.
It's also a question of what can China do, right? Because things like EVs and batteries, they're sort of front and center for the economic revival blueprint. So are there many options, either in the short term or the long term? I guess long term they can, invest and produce more offshore, a la Japan in the 80s and 90s.
That's right. I mean, right now, all the EVs, you're seeing a lot of Chinese manufacturers are setting up shops in Southeast Asia and also in Mexico as well, right? So many of the auto parts now is actually, for the U.S. market or for the North American market, is actually being manufactured in Mexico, right? So it's a very dramatic change from a couple of years ago. And also, if you look at the economy right now, the manufacturing sector is clearly making money. Export sector is making money, but then I think the property sector, if you look at the rental yield in many of the cities, is well less than 2%, right? So the ultra long-dated Treasury bond is yielding at about 2.2, 2.3%. So, it's actually even lower than the risk-free rate in the market. So that is telling you that, if you continue to sink even more money into the property sector, you're probably not going to get a really good result. I would rather see the government putting money in the economy that is still working, right? So that is still generating decent return. That is the manufacturing sector and also the export sector.
Hi Hong, always great to chat with you, partner and chief economist at Grow Investment Group. And speaking of EVs, China has started an anti-dumping investigation into imported POM plastic from the EU, US, Taiwan and Japan. This comes as a state media-affiliated account earlier warned that Beijing was prepared to take countermeasures if the European Union continued its anti-subsidy investigations into Chinese companies. The bloc started a trade investigation into Chinese-made EVs, if you recall, earlier this year. Well, from semis to solar panels, stocks in some of the world's fastest growing industries risk falling prey to another round of trade tensions between the US and China. Our Asia stocks reporter, Sang-Mi Chow, joins us now to discuss the winners and losers from these tariffs. So how are we seeing investors navigating this landscape? Who are seen as the losers and the winners?
Well, Heidi, the new tariffs were anticipated in the market, but what was not anticipated and what is really in focus is the fact that this might not be the end of it, because Biden and Trump are jostling to show the voters who can be tougher on China. And so this might not be the end of the new tariffs, but we might see more of them coming. And the whole focus here is whether Europe will follow suit, because the three key, the new exports from China, 45% of them are consumed by Europe. Those are namely solar cells, EVs, and lithium-ion batteries. And that compared to the U.S., which consumes just 0.2% of the solar cells and imports just 1% of the Chinese EVs, it's a massive difference there. So traders are going to be watching the moves from Europe coming there. And especially in the EV space, we have seen BYD, and BYD is in focus with, although, again, as I said, just 1% is going to the U.S. Again, the U.S. is aware that it is building factories in Mexico that could perhaps be used to circumvent those tariffs. So that's in focus. When it comes to the batteries, CATL is in focus, and especially with the ESS batteries that they produce, it is possible that they might actually have some upside, because the tariffs for the ESS batteries actually takes effect in 2026. So there could be more purchases before that. When it comes to the medical equipment, that came as a surprise from 0% to hiking to 50% suddenly, and that actually drove and boosted a lot of the Malaysian glove makers, the rubber glove makers shares high last week, and along with the Kumho Petrochemicals, that's a Korean company that produces latex for these rubber gloves. So these are very interesting sectors that we're watching, especially when it comes to chips. There could be some more volatility in SMIC, and solar. We are watching Trina Solar and Long E, but analysts are saying that there aren't going to be a lot of volatility there.
What else are you watching? It's certainly a busy week, both from central banks on the earnings front as well.
The key sector that we're watching is, of course, property, with the volley of new measures that's coming from the government, the easing of the mortgage rules, and the PBOC readying more of these measures. We're going to see how the equity reacts to this today, especially on Friday. We've seen the equity gauge of developers jumping almost 10%. So we'll be seeing, as the market parses this news, how it's going to react to this. We're also watching some of the travel stocks, with Trip.com reporting its earnings on Tuesday. We'll be seeing how the market reacts to this mentality of first travel and then spend in China.
Our Asia stocks reporter Sang-Mi Chow there. More to come here on Daybreak Asia. This is Bloomberg. China's EV makers are taking longer to pay their bills as a latest sign of stress in the increasingly cutthroat auto market. Let's bring our Asia transport reporter Linda Liu. And Linda, of course, we're expecting Xiaomi, Li Auto, as well as XPeng. Tell us what we're expecting in terms of these numbers, and why are we seeing the trend of delayed payments to suppliers?
For the upcoming earnings with the Chinese EV makers, Li Auto today, XPeng tomorrow, we're really watching for how well their gross margins are holding up. Now that, China's EV market has entered its newest phase of price cuts with Tesla and BYD taking the lead. So far, Li Auto's gross margin seems to be holding up okay. Analysts are expecting it to be still around 20% and also profit growth for this quarter. For XPeng, the picture seems a bit more mixed. Its revenue is projected to grow, but it's still making a loss. It hasn't been profitable since it was founded, but for this quarter, its loss is expected to narrow. And with this wider trend of Chinese EV makers taking longer to pay their bills and payables is really showing the pressure from this price war that's eating into these producers' bottom lines, really trying to, now they're really trying to make their cash stretch and manage their liquidity.
Yeah, it's interesting if you take a look at the numbers. NIO taking around 295 days to clear its receipts payable, most of which is owed to suppliers, versus 197 days in 2021. So that was 2023 versus 2021. How much further pressure do we see? And I guess what does this indicate for the wider industry, and what does it do for the wider industry?
The pressure is expected to persist, to continue to persist, because there's really no end in sight for this price war we're seeing in the Chinese EV market. And with the slowing growth for EVs in China and globally, and the uncertain economic outlook in China, the competition is only going to get more fierce in China. And that means the industry is really under this cash and liquidity pressure. Analysts we've spoken to said that all of these will be passed down from the EV makers to their suppliers, and then these bigger suppliers will try to really stretch out their payments onto their own suppliers. So it's kind of this flow-on effect where the smaller players are probably going to take a big hit, and the industry's consolidation will probably speed up.
Our Asia Transport reporter Linda Liu there. Well, Australian casino operator Star Entertainment says it's received inbound interest from a number of external parties, but has not had any substantive talks. Let's bring our global business reporter Angus Whitley. And this is a business that's been under pressure for quite some time. What's the latest in terms of potential external interest here?
That's right, Heidi. Star essentially has been forced to disclose that several suitors have approached it about possible deals after a newspaper report this morning that Hard Rock was leading a consortium that had already made a takeover proposal to Star. So effectively, Star is in play as a takeover target at the moment. Hard Rock's proposal is thin on details at the moment, but according to the report, it had proposed injecting fresh capital into Star, rebranding the company, and critically splitting Star's casinos in Sydney and in Queensland off its properties. So it's a breakup play.
Angus, what are the options when it comes to what's available to Star at the moment?
It's a company under huge amount of pressure. You might remember in 2002, an inquiry in Sydney found it was unsuitable to run the casino there. It uncovered all sorts of corporate wrongdoing, lax anti-money laundering controls. It had allowed Chinese gamblers to flout Chinese capital controls. It wasn't treating problem gamblers well enough. And since then, it's been operating under a government caretaker, if you like, government monitor in Sydney, which is its flagship property. And now it's in the middle of a second inquiry, and that will determine in July whether it will hold on to its casino license at all. So with all that in mind, it's not clear what a buyer would end up getting if it got hold of Star. So it's really sort of approaching Star at its lowest ebb, if you like. Its future's hanging in the balance, and it's almost a carbon copy of what happened to Star's main rival here, Crown Resorts. It went through the same kind of inquiries.
at all its casinos. It was bought by Blackstone Inc., and this year it got its license back in Melbourne. So a similar kind of trajectory for Star.
There's also been a number of hearings, investigations, probes, and a lot of which have revealed really quite extraordinary things that have been going on when it comes to Star's leadership and some of the strategies there. What's sort of the takeaway there? And I suppose, are we through all of that in terms of has all the dirty laundry already been aired, and that there is a chance for kind of a new leaf to be turned with potentially new investors, new ownership?
I think that's all to be decided. Last week, Star itself told the current inquiry that it didn't think it was suitable to run its casino. It argued for this kind of caretaker arrangement to be extended. And you're right, Heidi, we've seen just remarkable testimony to this inquiry. We saw the chief executive and chairman essentially plotting against the government-appointed monitor inside the company. They've subsequently resigned, so there's a leadership crisis in Star. There's an operational crisis. It's not clear whether it's fit to run the casino, and that's not going to be cleared up until end of July, when we get that report back from the inquiry. And also we have the Queensland casinos in the balance as well. They're waiting obviously to see what the outcome is in Sydney before they make a decision on their caretaker arrangements. So with all that, Star's shares, as you expect, have essentially collapsed. They're down 60% in the last 12 months. Company is worth now less than $1 billion.
Angus Whitley there, Global Business reporter, and we are expecting more developments potentially throughout the course of the day. We'll bring the latest to you when we get them, but we do have more ahead here on Daybreak Asia. This is Bloomberg.